Good morning. This is Karthikeyan Ramanathan, Senior Vice President of Zebu Share and Wealth Management Private Limited. Today we are going to discuss one most important thing in the stock market. Today, lot of stock market traders is involving in option trading. So, is my advice before you enter into the option trading, you just expertise in the option chain analysis. Then only you can make a clear decision whether the option is very cheaper or whether the option is in the right direction, whether the option is in a good strike rate. So then you can choose all based on this by option chain analysis. In this option chain analysis, we have to follow the simple steps. Just open that nseindia.com, then click in a search tab your favorite index or favorite stocks. Here I am using a Bank Nifty. Just click Bank Nifty here. After that, you just click option chain. So in this option chain, the expiry date of the option will be available here. You just open that expiry date. Here I am choosing a very near expiry, and then the strike price I have to choose, or else I just blank that, left it blank. So then I can able to get like this chart. Okay. In this area I have two types. One is call, another one is a put side. Another one, there are lot of terminologies here, right? The first one is open interest, another one is change in open interest. So we will discuss with each and every terminology in all our option videos. Stay tuned, and then we will talk about later like this week. Okay, first we have to look in that in this video we need to take care about the implied volatility, which is mentioned in IV. So either put side and call side, the IV is mentioned. Okay, the middle of the price, as we discussed earlier, the middle of the price called as a different strike price of the options. And then what is the current market price? The current market price will be floated here. There are two types of shading price here. One is pink shaded area, another one is a white shaded area. So either call side and put side, that shaded area called as a in the money. The non-shaded area act as a out of the money. And then the junction point of the two pink shaded area is called as in the money option. So whenever the market is trading nearby this, so the in the money option will be changed. So if you want to take a right strike, just go and open with nseindia.com or choose your option chain. Then that you can choose the direct point and midpoint of the both pink shaded area, which is called as at the money option. So you can choose 3800 as a at the money option. Okay. So in this implied volatility, for each and every option trader, you have to look implied volatility on day-to-day basis. If the implied volatility is directly connected with the people emotion, if the people thought that option price is very expensive, then the people won't show that much more interest on this price. If the demand is reducing, then the price will be falling down. So the option premium price will be falling down. So in this case, the implied volatility will be also coming lower. So whenever the market is traded with the highest implied volatility, then you can look and get better opportunity when that implied volatility is lower. So whenever you get a saturated price, like implied volatilities are nearly 19 or 15 or 20 like that. So instead of that a 40, 50 and 60 kind of range, then you can get an option in a very cheaper price. If that market direction is in a favorite for you, so that implied volatility will be start increasing. So you can directly synchronize with your option direction and then stock market direction. If the stock is clear bullish, then the implied volatility will be increasing from that range of 18, 19, 20, 21, 22 in the direction. Then you can prefer with that option buying in this condition. Okay. If you want to take a put option, if the market is clearly selling, okay, then the same thing will be implied here. Then the demand will be increasing to the particular stocks. Then the stocks will be automatically start increasing from that lower range to higher range. You can use this in that way. So the implied volatility, whenever the implied volatility is falling, then the option premium price will be falling. Whenever the implied volatility price is increasing, the premium price also will be increasing. So we can get a market direction like that way. So the 15 to 20 like that way, you can choose option premiums and to compare with previous. So stay tuned, and then we will discuss more about this implied volatility on how to take a trade and how to place a stop loss like that way in next videos. Thank you so much. Have a happy trading.